Hey, what's up, guys? So, I know you guys are probably looking at this, probably thinking, holy crap, I've got some crazy kid video thing going on here, but I just wanted to let you know that, why I was doing this video. So, I was going over this chart with my 2-year-old daughter last night, the alphabet chart. A for apple, B for ball, C for car, that sort of stuff. And I'm thinking, hey, how many letters can I figure out analogies to trade in with? And then so I started putting some stuff together, and I'm like, well, I think I could probably fill the entire alphabet with trade in acronyms. So that's kind of what the video is based about. So let's get into it. So the video is entitled Alphabet Trading Guide. Obviously, it's brought to you by ICEMAN Trading Academy. Let's get into the videos. First letter of the, oh wait, no. Before we get there, I'm going to explain to you what I'm going to be doing. Using the letters of the alphabet to create a guide to some trading terminologies, and I'll explain some of their meanings as we go along. So first, obviously, I'm going to be giving you the letter, the definition of the word associated with it, and a little explanation about the word itself. Now, for when I was doing this, I was realizing, you know what, that a lot of these words can be individual webinars by itself. So please, it's going to be a little shorter on obviously on the explanations because I can be here all day doing these 26 different letters. So I'm just gonna run through just a handful of it. Maybe if we get a lot of good responses to, hey, let's do individual, like, 26 webinar series or something. Maybe we can get into that. But for just for today, this is how it's gonna be done. Letter A for affordability. Now, before you start trading, you have to understand what you're getting yourself into. Affordability. Diving into the market without understanding it first can be a financial disaster. And when I say disaster, I mean you in debt, your family in debt, you're broke, your entire bank account is at zero. So affordability. Before you really start trading, before you put money into an account, before you decide to click any buttons, you need to understand, is this affordable to me? Is this something that I can really handle losing at? Is this money that it's not obviously money that you're willing to lose, but it's money that you have to be willing to risk in order to become a trader or an investor. So before you decide that, hey, I want to be a trader because, my friend's doing it and he's making a lot of money, before that happens, you need to evaluate for yourself, is this something I can really afford? And if it's not something that you can afford, if it is not money that you're willing to risk, do not think that you're going to be making money. You have to understand that there's a possibility that you will not make money, and there's a possibility that you will lose all of the money that you're starting with. Next, letter is B for a Bollinger Band. A Bollinger Band is a band plotted two standard deviations away from a simple moving average. It was developed by a famous technical trader named John Bollinger. Now, Bollinger Band is a technical indicator used by a lot of successful traders. Some successful traders only use Bollinger Bands. It's usually in a highlighted zone, so it's more like a cloud type trading, where basically the trader would like the prices to stay inside of that Bollinger Band as the price moves up or down. If the price breaks out to the upside, if they're long, for example, they may want to add into the position or scale out some of the position, depends on what point it's moving out over. If the chart breaks down to the underside of the cloud, they may want to exit some of their positions as part of the chart may be reversing at that point. Letter C stands for candlesticks. A candlestick is a type of technical charting style originated by Japanese rice traders. Now, I did an entire webinar on candlesticks. This is the charting style that I use. There are a lot of different charting styles out there. This isn't obviously the best one. This is the best one for me. This is the best one that I have come up with, that I like using, that I'm comfortable using, and that I understand pretty well about what they do. The candlesticks themselves are a graphic depiction of human emotions. So as the candlesticks themselves go up and down, those are human emotions. Obviously, now in these days, it could be computer emotionless, but nonetheless, they're still graphic depictions of what's really going on. So a candle going up or a candle going down signals obviously strength in buying or weakness in selling. And so candlesticks is letter C. Letter D is for dedication. Dedication, the willingness to give a lot of time and energy to something because it is important. So, in trading, in everything that you do in life, if you're not dedicated to it, it's going to go nowhere. If you plan to do something and you don't stick your guns at it, it's not going anywhere. It will fail, much like trading. It's not something you're going to get up at 9:25 every morning and you're going to just pull up your charts and make money. It just isn't going to work like that. I don't care if you're with somebody, if you're trading with somebody, if you're trading by yourself. It's just if you're not dedicated to this craft, it will fail you, and so then you need to reevaluate what you want to do with it because it's probably not going to work out for you if you can't find yourself studying, going over charts, reviewing things, having some sort of a game plan. If you're not dedicated to this, it will fail you. And so you need to reconsider how you do things if you don't plan to be dedicated to it at all. Next letter on your alphabet is E, stands for ETF, Exchange Traded Fund. It's an investment fund traded on stock exchanges, much like stocks do. An ETF holds assets such as stocks, commodities, or bonds and trades close to its net asset value over the course of the trading day. Most ETFs track an index, such as a stock index or a bond index. There are a lot of different types of ETFs. Obviously, they are related to all the other commodities out there, all the other indexes. For the main ones that obviously I follow are the gold ETFs, which obviously track gold futures. Oil ETFs, natural gas ETFs, there are financial ETFs, all sorts of different types of ETFs. I mean, you can really have a lot of work when it comes to ETFs. A lot of traders don't touch ETFs, particularly newer traders or even experienced traders. They will say they will stay away from trading ETFs because they're very dangerous, and that's true because they're very volatile vehicles to trade. So, and if you're not sure about what they're associated with, it makes no sense to put your money in there because if you're not following the bigger commodity that it's trading against or with, you're going to be fighting against something that you have no control of. The next letter is F, stands for fear. An unpleasant emotion caused by the belief that something is dangerous. A lot of as far as fear goes with trading, it's an emotional conflict that a lot of traders go through. Almost every single trader sometime in their career goes through this emotion. It's one of the most important emotion that you need to overcome as a trader. I don't care if you're new or if you're experienced, fear will step into your trading career at one point in time. If you're a new trader, your fear of pulling the trigger, your fear of losing money, it's your fear of everything that's possible that can happen. Your fear of letting winning trades go because you're fearful that you may end up losing all of that money that you're seeing in front of you. Fear is a big emotion. It must be controlled or it will eat away at your account. It will eat away at you mentally and physically. So if you are a trader, understand that fear is an emotion that needs to be controlled. It can happen to anybody at any time in their career. It can happen to new traders. It can happen to experienced traders that have plateaued or that have had days, losing streaks, and fear starts seeping in, and then it'll take control of your accounts really, really bad. It'll take control of you really, really bad. Next letter is G, stands for greed. It's another emotion that it's the definition of greed: intense and selfish desire for something, especially wealth. So a lot of traders get greedy. They get greedy on obviously how much money they're making. What else are you getting greedy on? That's what it comes down to. You're getting greedy on how much money you're making. You're seeing you're making a lot of money. Maybe you're seeing somebody else making a lot of money. Maybe you're not understanding that that's not your account. Maybe you're seeing your trade that you wanted to make $200 on go to $400, and you want it to go to $600 now because that's just the greed setting in. And what happens is something something goes wrong with that trade, and it fails, and you lose all of your earnings, all of your winnings that you had all the time along during the trade. Greed is another emotion that you need to cap. You need to figure out where there's a balance between having a winning trade, win for you, and having greed set in. So that's an emotion that you need to get under wraps before it messes up with your trading. A lot of great traders will end up losing a lot of money because of greed. They'll overnight something because it was going up, and you know it's crazy high, and you're still overnight and expecting for that little push. So you try going for that one more dollar or so on a swing, knowing that it's super extended, and you wake up the next day and it's down $10 or something. So that's greed right there. Next letter is H. Now you've heard me use this term a lot in previous webinars. It's my holy shit stop. It's that stop where you say, "Holy shit, I can't believe that price went down to that area." And so it's that stop that protects me from going broke. It's that stop from helping me not to blow up my account. I don't have these huge days where I end up losing, 50, 60, $70,000. I don't have those days. My holy shit stops are really set at that, less than $10,000 range, where it's like, holy shit, I can't believe that price of went down there. I'm a very technical trader, but sometimes I will give things a little extra room to move. Maybe I'm a little bit biased on it because of a chart, or maybe I'm looking for a little bit longer term. But then something happens that obviously a catalyst or something that affects the trade negatively, it goes against me, and that's where my holy shit stop would come in. It would protect me from taking a bigger loss than I'd want to. That's my holy shit stop. Next letter is I, stands for inflation. Inflation is a sustained increase in the general price level of goods and services in an economy over a period of time. So inflation happens when money is pumped into a market, producing less value for the dollar amount itself. Next on the list is J. J is for journal. Every trader should have a journal, a personal record for occurrences, experiences, and reflections kept on a regular basis. I have a journal. I have a log of every single trade that I've taken, a reason box for why I took the trade, an entry point, a stop point, a profit, and if the trade continued to go the direction and why I didn't go with it, or if the trade went against me and why I stopped out of the trade completely. It shows a lot of specifics also about, how much did I put into the trade, what did I get out of the trade, was it a yes no trade, was it something that no matter what the turnout I would still take the trade today even if it was a red trade, was it a no trade, was it a trade that I should not have gotten myself into and I still went ahead and did it. All these things are recorded in my daily journal. You should have one too. Next letter is K. Keep up with the alphabet. Knife. A fallen knife is a phrase used by traders for a security in which the current price might have dropped significantly. A fallen knife is basically saying, wow, holy crap. That's where your holy shit stop comes in, by the way. Wow, that thing really tanked. That's a fallen knife. So you'll hear a lot of traders talking about catching a fallen knife or not trying to catch a fallen knife, which is a very difficult thing to do. Could be a very profitable way if you can actually hit the bottom of it. A lot of traders would overshoot that and miss that area. Technically speaking, I'm pretty okay with catching fallen knives. I'm not a pro at it. I've missed quite a few of them over my days, but I've caught quite a few of them myself. So that's the terminology for K. Liquid. A liquid stock is a stock that is easily bought and sold. due to the fact that there's a large volume of shares traded each day. A lot of traders would only trade liquid stocks. They wouldn't trade what is the opposite of liquid stock, a very thin stock, a stock that doesn't have a lot of volume in it. So a lot of traders that maybe wanna turn over a lot of shares per day or per time when they're trading it, that you want to be able to get out of the shares that you got into. If you have 100 shares and nobody wants to buy that 100 shares from you, even if it goes up 1,000% and nobody still wants to buy it from you, it's not worth anything to you. So the stock has to be liquid enough where you can actually sell back the shares that you have in your hand. Next letter is M, starts for moving average. A moving average, or MA as it's called, is a trend following or lagging indicator because it's based on past prices, meaning that they're not the actual indicator as it is right now. It's always obviously something that's a little bit lagged. So an indicator, like a moving average, is usually just a curved line that follows the path of the price. I use moving averages a lot. It's one of my main technical usage on my charts. I use the EMA, which stands for the exponential moving average. There are also SMA, which stands for simple moving average, and TMA, which stands for triangular moving average. Next letter is N, stands for news feed. A news feed is any source of trade-related news or events. A news feed doesn't have to be an expensive, fancy news feed from a big company. It can be from a cheaper company. It could be from no company. It could be from Twitter. A news feed is anything that gives you news, anything that's feeding you any sort of information that may help you to benefit, your trading day. Next letter is O for overtrading. This is a big issue for a lot of traders. I myself have overtraded. I still do. I find myself still getting into situations where I should not be taking any more trades, and I still find myself overtrading at some points. There's a big difference in overtrading and having consistent winners and keep trading. You can overtrade if you're taking consistent red trades and then you keep making more red trades. That's overtrading. If you're trading and you're consistently making money and the trades are still working for you, that's not over trading if you're still making money. So there's a big difference with taking a lot of trades and losing and keep on trading. That's what over trading is about. Next letter is P, as the opposite from knife. It's parabolic. It's a terminology used for a security that's increasing dramatically in price in the set time frame. Now, why I say set time frame is because a lot of people think about parabolic moves. They think about intraday moves. They think about a big news or a chatter on a company, and it shoots up the price. But it does not have to be on the day itself. There could be a parabolic move into a time frame, say on a daily chart. It could be a parabolic move into a few weeks, into a few days, into a few months, a few years. It could be a parabolic move into those types of time frame also. Next letter is quantitative easing. Now this is short for QE. It's a monetary policy used by central banks to stimulate the economy when standard monetary policy have become ineffective. So basically, QEs are central banks buying longer-term government bonds, and therefore they're lowering the longer-term interest rate possibilities. R is for reverse split. Reverse split is a reduction in number of a company's traded shares that results in an increase in the par value or earnings per share. So reverse splits happen all the time. It happens in ETFs. It happens in OTC. Happens all over the place. A reverse split basically means that if you have 100 shares and they're doing a 10-to-1 reverse split, that you'll end up with 10 shares. Next letter is S for sector trends. A sector, an area of the economy in which businesses are the same or a related product or service. So you get sectors like the healthcare sectors, transportation sectors, mining sector, oil and gas, financial sectors, energy sectors. Now, when people say sector trends, they usually is trying to tell you that like maybe this sector is hot, like maybe the energy sector is hot, so maybe you want to play energy related stocks or ETFs. If gold is being bought up, you want to play those sort of related sectors. Next letter is T, trend line. A big one for a technical trader like myself. It's a horizontal or diagonal line drawn on a chart for to show a direction. It shows support and it shows resistance areas. A trend line is basically a simple line that you draw from one point to another point, trying to signal a direction in your chart. It could be a horizontal line, it could be a diagonal line. Once the lines are broken, it kind of gives you an idea of, hey, maybe the trends are reversing or maybe things are changing a bit. Next letter is U, underwriter. An underwriter is a company or other entity that administers the public issuance and distribution of securities from a corporation or other issuing bodies. There are a lot of underwriters out there. Some of the bigger names are JPM, Goldman Sachs, Bank of America, Citigroup. These are all underwriters that back other stocks. Letter V stands for volume indicator. This is a very powerful tool. It's often overlooked because it's such a simple indicator, meaning that what are you trying to say? That the volume's up, that means the price is going up. Well, if there are more buyers, they're technically saying if people want to buy it, the price will increase. So yes, volume indicator is a very simple indicator. It's something that every trader should have on their account. It's a very important, simple indicator to use, and it should be applied to all of your charts. Letter W starts for wiggle room. Wiggle room, the allowance or for price movement against your trade in order to retain your position. Say for example, your wiggle room would be if you have a trend line or a horizontal line which gives you a support at $25 and you're long at this stock at $25.50, so your stops are below that $25 level because that's your wiggle room. You're allowing it to go, say, 20 cents or 30 cents under that area, for example. That gives you a wiggle room, a buffer zone that allows the price to pull back to that area without stopping you out, as long as it doesn't give you a drastic reduction. Obviously, then you have your holy shit stop to protect you from that. And I'm up to letter X, and this one kind of really, it was trying to find a word in there that really kind of stood out to me, but it was difficult. So, letter X. X-ray. It's a term I use for scanning stocks based on preset filters. Much like an X-ray machine does, it scans your bones. The preset filters on your scanning tools are going to help you to get rid of some of the noise. Some of the when I say noise, I'm not talking about intraday noise. I'm talking about just noise on your charts. If you're scanning daily charts, for example, you want to obviously avoid the charts that maybe have traded 100,000 shares over a daily range. Maybe you want to scan for stuff that's trading over 300,000 shares per day. Maybe you want stocks that are filtered based on, hey, I can't trade price line. Maybe that's something that you want to filter out. So your X-ray is basically your filters. I actually have a scan called X-ray, which was funny, but yes, it's a term for scanning stocks. Letter Y, we're almost to the end, is yield. A yield is the income return on any investment, such as the interest or dividends received from holding a particular security. The yield is usually expressed as an annual percentage rate based on the investment's costs, current market value, or face value. So it's obviously a yield is what it is. You can also research yield curves. It's gonna help you to understand dividends and how your company or investment can help you further on. Last one is 0, and you should understand what that number is because if you followed from letter A from affordability, if you cannot figure that step out, you will end up here at 0. Its success rate in this business is actually about 3.5 to 4.5%, which means that about 95% plus of day traders actually fail this business. It's considered to be one of the dumbest career decisions that you can make. Maybe it's one of the most profitable career decisions you can make, but it's also considered to be one of the dumbest career decisions that you can make. So, if you are not all of those terminologies that we went through, if you're not following most of those or all of those as some sort of a guideline, this is sadly where you will end up at the last letter of the alphabet at zero. So, in order not to be at zero, you have to go through all of those and more. Okay, but definitely focus, 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 because this is not an easy road, and it's going to take a lot of work. It's going to take a lot of dedication. It's going to take a lot out of you. So understand that it's a long process. And for those of you that don't follow me, there's my Twitter handle and my new trading group, ICEMAN Trading Academy. And so if you want more information on that, just let me know through Twitter or email me. Thank you guys very much.